Hello, this is Bear from Elliott Wave. How's it going? Here's a new video on JP Morgan. Today we're going to take a look at another one of my holdings, see what's happening, what could be happening using the Elliott Wave theory. So as you can see here, let's just dive into the account. We're looking at a potential 1-2 with the 2 bottoming with the 2009 low, and then a potential resumption of the overall upside trend into 1-2 of intermediate degree, 3 sharp 4 with the COVID lows, and then resumption into wave 5. As of right now, it looks like we could have completed a wave 1 of intermediate degree, and either we have a wave 2 in place, very common for wave 2s to end near the wave 4 of 1 lesser degree, or else we can be in wave B of 2, and we could see further downside into wave C to complete the overall correction, and that could take us all the way down to, again, the area of the previous wave 4, which would obviously correspond to the area of the COVID lows to somewhere between $100 and $80. So in addition to that, if we look for some ratios, we have the 61.8% wave 3 of cycle degree against 1 at $96. So it brings additional confidence to the count. And as you can see here, we found on that level many times support and resistance. Here it acted as support. Here again it acted as support. If we do go lower, could we see further support and then resumption higher? So those were the main bullish count. As for the bearish alternate, we could either be in a wave 3, short 3, and we could be in the beginning stage of a larger degree wave 4. However, as this would be invalidation level at around $70, so overlapping on wave 1 and 4, we shouldn't expect to see a much deeper retracement than what we expected with the previous count. Therefore, it kind of go against the idea of having a wave 4 of such a large degree, as it would have to pair up in terms of magnitude to the wave 2 of the same degree, and that would also mean invalidation level. Or else, if you want to be bearish, we expect a wave A, B, and C, and then see further downside in the following months. With that being said, let's take a look at the daily chart. Here, we're just going to stick to the main count with a wave 2 in place. It looks like if we zoom in, we could have had a wave 1 and 2 with a leading diagonal to wave 1, sharp correction to wave 2, found support, have another 1 and 2. As you can see here, we have what appears to be a clear 3-wave move to the downside. So at this point, if we are correct, we should expect further upside, break this point, potentially retrace, and then continue higher. So last but not least, let's take a look at the moving averages. As you can see here, we're having a cross of the 20 in red and 200 in purple EMAs. As you can see, that usually represents a bullish sign, so we are finding support on both of the averages, and we shall see if we will continue to the upside. As per on the weekly, we crossed here in December of last year, and ever since we are now below the 20 EMA. So that being said, technicals are looking in favor of additional upside. There's still no reason to be bearish. And now we can take a look at our dividend data. So as always on the portfolio videos, we're here on Second Alpha. We're seeing how JP Morgan is currently up for the year 5.8%. and up just slightly above 12% for the year. If you take a look at dividend history, we can see how the current yield stands at 2.94%, and we just had an increase from $1 to $1.05 for the quarter. So as you can see here, there has been continuous growth for the past 9 years, starting from 25 cents all the way up to $1.05 with the most recent payout. So if you look at dividend safety, you can see how the cash dividend payout ratio stands at just below 25%, which is ideal for what we want to see in the portfolio. And we are almost 50% down on the 5-year average at 43%. So despite the fact that dividend growth has been pretty slow for the past 1 and 3 years, we've seen how the cash payout ratio has been almost halved. So last but not least, let's take a quick look at valuation. If we look at price to earnings known gap, stands at 8.54 against a 11 and 15 with a 5-year average. Very similar to the price to earning gap with a 12 trailing month at 8.53 against a 11.48 for the 5-year average. So it seems to be undervalued if you consider price to earnings. So that was it for me today. As always, a quick look at the Elliott Wave count and some dividend data. Let me know if you'd like me to go more in depth in both the counts and the valuation. Let me know what you'd like me to see next. I'm also curious to know if you do have a dividend portfolio and why you're holding cars, and if you do own, indeed, like myself, JP Morgan. As always, don't forget to subscribe if you don't want to miss out on the next update, and I'll leave you the link to my analysis of all of my holdings so far that I covered on the channels. The link should be up here as I'm speaking. Thanks for watching. I'll see you in the next one.